Welcome back to Your Average Investor, the channel that looks at my journey through investment, budgeting and finance. In today's video, we're going to take a look at a question that's been asked quite commonly in the comments on my videos, and that is, what is the difference between an income and an accumulation fund? Obviously, when you're starting out investing, there's lots of terminology that you might not quite understand, and it's really important to get a good grasp of what each different fund means before you invest in one of them, so that you make sure the product you're investing in is right for you. So what we'll do today is we'll take a look at an income and an accumulation fund, look at their differences and their similarities, and hopefully this will help you decide which is the right avenue for you to follow. We'll also then take a look at my Vanguard portfolio, as like I said in the last video, it has seen some quite impressive growth since the last time we checked in on it. If you find videos like this useful, please don't forget to like and comment below, and consider subscribing to the channel if you haven't done so already. So with that said, let's hop into Vanguard and have a look at the difference between an income and an accumulation fund.
Here we are then back on Vanguard's website. Most funds out there offer both income and accumulation variants of the fund. One example of this is the Life Strategy 100. Now, I've already spoken about the Life Strategy 100 in quite a lot of detail in a previous video, as I think it's an excellent place for beginner investors to start. So what we're going to do today is we're going to take a look at the Life Strategy 100, both the income and the accumulation variants of the fund, and look at some of the key differences between the both of them. By selecting the Life Strategy 100, you can see that Vanguard automatically presents the accumulation variant of the fund. However, it does mention that it is available in other share classes. Before we do a side-by-side comparison of the two variants of this fund, it might be a good idea to explain what an accumulation fund and what an income fund actually is. An income fund essentially pays a dividend to you at selected points throughout the year. What this means is that the dividend will go straight into your account, whether that be your investment account or in some cases your bank account. The dividend provides you with a steady stream of income, and if your investment pot is large enough, you can actually live off this income. In comparison, an accumulation fund is fully automated. Any dividend or distribution that you get within an accumulation fund is automatically reinvested back into that fund, so you don't ever get the decision of what to do with it. This reinvestment back into the fund raises the value of one unit of that fund, and therefore the compounding effect has a chance to take hold. Just so there's absolutely no ambiguity, Barclays also offer a clear definition of both an income and an accumulation fund. This is pulled directly from their investor website. It states that an income unit will distribute any interest or dividend income from the fund directly to you. As a result, you may receive an income from your investment at regular intervals. In comparison, an accumulation unit is designed to offer you growth in the fund rather than income. So income will be generated and reinvested back into that fund, raising the value of your investment. If you want to have a read of that document yourself, I'll put the link below in the description to the Barclays website. So now we've cleared that up, let's have a look at the two life strategy variants, the accumulation and the income fund. Here we have Vanguard's Life Strategy 100 accumulation variant of the fund. You can see that at the time of filming, one unit of the fund is worth £229.02, with an ongoing charge of 0.22%. You can see that the asset allocation is obviously 100% towards equities, and the risk rating is 5 out of 7. If we take a look at the income variant of the fund, you can see that one unit of the fund is considerably less, at just £195.37. You can see that the ongoing charge fee matches that of the accumulation fund at just 0.22%. The fund also has 100% equity, as you would expect, and equally the risk rating is again 5 out of 7. Looking back at the accumulation variant of the fund, you can see that from an initial £10,000 investment in May 2011, that same investment is now worth around £21,000, with a nice stepped increase over time. This accumulation fund obviously takes into account the continual accumulation of dividends into the value of that fund. If we take a look at the income variant of the fund, you can see that the growth or performance graph is exactly the same as the accumulation fund. If we take a look at the portfolio data of both variants of the funds, you can see that the funds included within the Life Strategy 100 are exactly the same, with the same allocation and weighting towards each fund included. So here on this screen, you can see the accumulation variant of the fund, and then if we flick across to the other screen, you can see that the allocation and weighting within this variant, the income, is exactly the same as the one you saw before, the accumulation fund. The final element to analyse then is the distributions element, and this is where obviously we see the majority of the differences between the accumulation and the income fund. This variant is the accumulation fund, and as you can see it gives no distribution frequency, however it does give a yield per year. The reason for no distribution frequency is because distributions or dividends are not paid out as income, they're automatically reinvested back into the value of the fund. You can see that year on year, the yield at the moment is 2.35%. This 2.35% then is essentially 2.35% of the value of the fund added back on to that fund, and you can see therefore how the compounding effect has a chance to take hold. On the other hand, if we look at the income variant of the fund, you can see that the distribution frequency is listed as annually, meaning that you'll get one annual dividend payment if you invest in the accumulation variant of the Life Strategy 100. Again, in comparison to the accumulation fund, the income fund is listed as having a distribution of 2.41%. This yield is the only real difference between the income and the accumulation fund that I can see. From my point of view, when I first started investing, I decided to invest through a Life Strategy 100 accumulation variant. And the reason for this is because I wanted to be a completely passive investor. I wanted to be able to invest in the Life Strategy 100 as I got more knowledge about the stock market and investing, and know that it would continually tick away in the background for the first year and then for years to come. If at some point in the future you're looking to live off the dividend of the investment by taking it as income, I'd obviously recommend taking the income variant of the fund. However, if you're starting out investing, and if you're like me when I started, and you just want the simplest way to do it and know that dividends will be reinvested, and you can just invest a small amount each month and slowly watch that grow, the accumulation fund is probably the better variant for you. Now, as I've got more into investing, I've read more and I've got a better understanding of it, I've now moved into ETFs, exchange traded funds, and some individual stocks and shares as well, which will pay me a dividend. And this obviously gives me the opportunity to reinvest that how I see fit. So the decision between an accumulation and an income fund is really down to you and your personal investing goals. This is obviously something that you'll have to consider yourself when starting to invest, and if you need further support with that, you'll have to seek independent financial advice. So let's hop in and take a quick look at my own Vanguard investment portfolio. We last checked up on this account about 2 weeks ago, and if you've seen that video, you'll be able to notice that my rate of return has increased quite substantially in that time. In the last video, I had a 2.85% rate of return, and you can see that that's now increased to 10.3%, which is really impressive in the 2 weeks. The overall value of my portfolio has increased from £3,191.78, and it's now valued at £3,334.80, an increase of almost £150 in under 2 weeks. Now, the stock market's been having a particularly strong time recently, and while there's still lots going on globally, there does seem to be a bit of a disconnect between the stock market valuations and the state of the economy. There are lots of people out there fear-mongering, suggesting that a big drop's coming, and while that might be true, I'm going to continue to invest as I would do following my normal strategy of pound cost averaging. Nothing changes for me as I see it. This money is in here for the long term, for the next 35 to 40 years. So any small or big dip at the moment just gives me an excellent buying opportunity. In the last video I showed that I had around £140 in available cash in my investment ISA, and suggested that this was for me to invest throughout the month as part of my pound cost averaging strategy. You'll be able to see that I've currently got 4 pending buy orders which I placed this morning, and this is to reinvest into the 4 ETFs that I'm invested in. Funnily enough, as I've clicked through to show you what I've been investing in, they've all just completed. As you all know, I'm a big believer of time in the market is better than timing the market. However, over the last few days, and especially this morning, the stock market has pulled back somewhat, and therefore I decided that today was the best opportunity for me to buy back into the funds that I would usually be investing in. Whilst I'm still pound cost averaging and I'm not really timing the market here, investing in these small little dips will help the value of my portfolio over time. If we take a look at all of this in terms of my individual investments, you'll be able to see that my investment in the emerging markets is now up over 14%, seeing it return to me over £20. The FTSE Developed Asia ex Japan is the fund that I've held for the shortest period of time, and I was fortunate enough to buy into this during the dip of coronavirus, and therefore it's netted me a rate of return of over 26% in around the month that I've been investing into it. This really is excellent, and it does show the advantage of being able to get in on things at the right time. That 26% rate of return equates to a £27.93 total return. If we take a look at the FTSE 100, you'll notice that it's been slowly developing and improving for me over time. In one of the first videos, my total rate of return was negative 27% for the FTSE 100 ETF. You can see it now sits at around negative 9%, with a total loss of £19.10. Now, this did hit positive rates of return earlier in the week. However, over the last day or so, the FTSE 100 has reduced in value quite a bit, and therefore it's fallen back into a negative rate of return. My S&P 500 investment has really turned itself back around. From sitting at a negative rate of return in one of my previous videos, it now sits at almost plus 15%, which really is excellent, and again equates to £73 in capital growth. Finally, my Vanguard Life Strategy 100 accumulation variant investment is up around 8.5%, which equates to around £56 of return. If we take a look at the month, you'll be able to see that in June so far, my investments have returned to me £115. In total then, all of this equates to a capital growth of £157.54 from my total investment of £3,180. You can see that as depicted on this graph at the bottom of the page, with the value of my investment steadily increasing before coronavirus and then climbing back out the other side again due to my continued reinvestment and the rally in the market.
So there we have it, a simple explanation of what an income fund and an accumulation fund is. And hopefully that's helped you understand which is the right one to invest in for you. Initially, I started investing in the Life Strategy 100 accumulation fund. But as I got more knowledge and I started to read more and more about investing, I decided to invest in income ETFs, as this gave me that continual income every few months. This is then obviously reinvested, but into the fund of my choice rather than back into the same fund over and over again. As you saw from my own portfolio, this strategy has helped the value of my portfolio steadily increase over time, with it now having quite a nice rate of return. Once again, I hope you found this video useful, and if you do find these videos helpful, informative, or you just like looking at my portfolio develop, please don't forget to like and comment on the video and subscribe to the channel as well. And with that said, I'll catch you in the next one.